Investing is a journey, not a race. It's a long-term commitment that requires patience, discipline, and a clear understanding of your financial goals. It's about growing your money slowly and steadily over time. Just like a plant needs time to grow, your investments need time to mature and yield returns. This is how you build real wealth that lasts. By making informed decisions and staying the course, you can create a financial foundation that supports you and your family for generations. Two popular ways to do this are index funds and exchange-traded funds, or ETFs. These investment vehicles offer a way to grow your wealth with less risk compared to individual stocks. Both let you invest in a basket of stocks, providing instant diversification. This means your risk is spread out, reducing the impact of any single stock's poor performance. But they have key differences. Index funds are typically managed passively, while ETFs can be traded like individual stocks throughout the day. This guide will help you navigate the world of index funds and ETFs, exploring their features, benefits, and potential drawbacks. We'll break down the complexities, weigh the pros and cons, and equip you to make informed investment decisions. Understanding these nuances can help you tailor your investment strategy to your specific needs and goals. Whether you're just starting your investing journey or seeking to refine your strategy, understanding these investment vehicles is crucial for long-term financial success. Imagine a basket filled with a variety of fruits. Each fruit in this basket represents a different type of stock or company in the stock market. Just like how a basket can hold apples, oranges, bananas, and grapes, the stock market is made up of various companies from different sectors and industries. This basket represents the stock market, a collection of all these different companies. When you invest in the stock market, you are essentially buying a piece of this basket. With each fruit being a different company, you get exposure to a wide range of businesses. This diversity helps spread out risk because the performance of one company won't drastically affect your entire investment. An index fund is like buying the whole basket. Instead of selecting individual stocks, you invest in a fund that holds a variety of stocks, mirroring a specific market index. Instead of picking individual fruits or stocks, you own a piece of everything. This means you don't have to worry about choosing the right stocks. The index fund does it for you. Index funds aim to mirror the performance of a specific market index, such as the S&P 500. These indices track the performance of a group of stocks, providing a benchmark for the overall market. This means that if the S&P 500 goes up by 10%, your index fund investment should also increase by roughly 10%, minus fees, of course. This makes index funds a simple and effective way to passively participate in the overall growth of the stock market. They offer a low-cost, low-effort investment strategy that can be ideal for both novice and experienced investors. ETFs are similar to index funds in that they also hold a basket of assets. However, ETFs are traded on stock exchanges, just like individual stocks. This means you can buy and sell ETFs throughout the trading day, giving you more flexibility than index funds. This ability to trade ETFs intraday makes them appealing to active traders. However, it's essential to remember that long-term investors should prioritize the underlying assets and expense ratios of ETFs, just as they would with index funds. The goal is to find investments that align with your financial objectives and time horizon, not to chase short-term market fluctuations. Index funds are like autopilot for your investments. They follow a specific market index, such as the S&P 500. This index is like a list of the 500 biggest companies in the US stock market. When you buy an index fund, you own a tiny piece of all those companies. This simplicity is a key advantage of index funds. You don't need to research individual stocks or try to time the market. The fund managers do the work for you, ensuring your investment stays aligned with the chosen index. This passive approach typically leads to lower fees compared to actively managed mutual funds. Section 5. How ETFs work. Trading. Like stocks, ETFs are like index funds, but with a twist. They trade on stock exchanges just like individual stocks. This means their prices fluctuate throughout the day based on supply and demand. You can buy or sell ETFs anytime the market is open. This flexibility makes ETFs appealing to some investors. You can use them for short-term trades or long-term investments. However, this trading flexibility can also be a drawback. It might tempt you to buy and sell frequently, which can lead to higher trading costs and potentially lower returns in the long run. Section 6. The benefits of index funds, simplicity and stability. Index funds offer several key advantages for long-term investors. First, they are incredibly simple to understand and invest in. You don't need to be a financial expert to get started. Second, index funds are very low cost. Because they passively track an index, they don't require expensive research teams or frequent trading. Third, index funds provide instant diversification. By owning a small piece of hundreds or even thousands of companies, you spread your risk across the entire market. This diversification helps to protect your portfolio from the ups and downs of individual stocks. Section 7. The advantages of ETFs, flexibility and tax efficiency. ETFs also offer several benefits. Their flexibility is a major advantage. You can trade them throughout the trading day, just like stocks. This makes them suitable for a wider range of investment strategies. ETFs can also be more tax efficient than traditional mutual funds. This is because ETFs are structured in a way that typically results in fewer taxable events, such as capital gains distributions. This tax efficiency can help to boost your after-tax returns over the long term. Section 8. Weighing the risks. A balanced perspective. Both index funds and ETFs carry risks. The most significant risk is market risk. If the overall stock market declines, both your index fund and ETF investments will likely lose value. It's crucial to remember that diversification helps mitigate risk but doesn't eliminate it entirely. Another risk to consider with ETFs is the potential for tracking error. This is the difference between the ETF's performance and the performance of the underlying index it's designed to track. While generally minimal, tracking error can impact your returns, especially over extended periods. Section 9. Making the choice. Finding the right fit for you. So, which is better for long-term investing, index funds or ETFs? This is a common question among investors, and the answer isn't always straightforward. The answer, like most things in finance, is it depends. It depends on various factors, including your financial goals, your risk tolerance, and your investment horizon. If you prioritize simplicity, low costs, and a truly passive investment approach, index funds are an excellent choice. They are designed to mirror the performance of a specific market index, providing broad market exposure. If you value flexibility, the ability to trade throughout the day, and potentially greater tax efficiency, ETFs might be more suitable. ETFs can be bought and sold like individual stocks, offering more control over the timing of your trades. Ultimately, the best choice for you depends on your individual investment goals, risk tolerance, and investing style. Take the time to evaluate your needs and consult with a financial advisor if necessary to make the most informed decision.